Hello traders, welcome back to a new educational video. This one might hurt your feelings and ego a little, but believe me when I say it will do you good in the long term. You're not losing because of your strategy, you're losing because of your risk management. You can know structure, liquidity, patterns, all of it, but if you don't control risk, you'll never be profitable. Why? Because knowing where to enter is not enough. You also need to know how much to risk, how to size your position, and how to stay consistent over time. Because at the end of the day, trading is not about one trade, it's about a series of trades. And if your risk is not controlled, even the best setups won't save you. In this video, I'll show you the rules that actually keep you in the game. So let's get into it. Before anything else, you need to know how much are you willing to lose per trade. Not how much you want to make, not how confident you are. How much you're okay losing. Why this comes first? Because every trade has uncertainty. Even the best setup can fail. So instead of trying to avoid losses, you control how big they are. That's what keeps you consistent. Most consistent traders risk about 0.5% to 2% per trade. This risk is always applied to your account size, but more specifically, your current account balance. For example, if your account is at 10K and you risk 1%, then your risk per trade will be $100. So no matter the setup, if your stop loss is hit, you lose $100, not more, not less. As your account changes, your risk changes too. For example, the same account starting at 10K. If you risk 1%, you have $100 stop loss. Let's say you take a few losses and your account size goes to 9K. You still risk 1%, but that now means $90. When your account grows to 12K and you're risking 1%, your stop loss will be at $120. This keeps your risk proportional and consistent. Why this is powerful? Because it protects you during drawdowns. It scales you up when you grow and keeps everything controlled. If you don't define your risk, you'll end up risking more on good trades, less on bad ones, and your results become random. Your trading becomes emotional. And over time, inconsistency equals losses. A lot of traders change risk based on feelings. This setup looks perfect. I risk more. I'm not sure about this setup, and I risk less. That's emotional trading, not strategy-based trading. Professionals do the opposite. Same risk, every trade. So the real goal is not to avoid losses, is to survive them. Because losses are part of trading. So risk per trade is what allows you to take multiple trades without fear, stay objective, and avoid revenge trading. Because you know that no single trade matters. And this is how we get our first rule. If you control your losses, profits will take care of themselves. Now, let's talk about position sizing. This is where risk management becomes practical. Because knowing you risk 1% is not enough. You need to know how to apply it to every trade. Position sizing is simply adjusting your trade size so your risk stays the same every time, no matter the setup, the stop loss, the market. Most traders do this. They pick a lot size first, then place a stop loss. This is backwards, because now your risk is random. The correct process is first you define your risk, then set your stop loss based on structure, and last you calculate your position size. Let's break it down with an example. We have defined our area of interest for shorts, which is our Fib algo and an anchored view up from the swing high. Knowing our entry price, which is at 58K, now we need to define our stop loss based on structure. And that will be above the 886, which is the last line before price can make a new high. We know our stop loss is 8.4%. Now we have to calculate our position size. And the question is, what is my position size in order for this 8.4% stop loss to be equal $100 I am willing to risk? And this is how we do it. We take our stop loss and we divide it by multiplying the entry price to our stop loss. So in our case, will be $100 divided by 58K multiplied to 0.084, which means 8.4%. And this is how we get our position size of 0.02 Bitcoin, which means $1,160. Now, for take profit, using a fib extension from the swing high to the low that caused the market structure break and to the high of the retest, we get a 1618 target, which for our trade means 47% win. This 47% will be applied to our position size of $1,160, and that will mean $545 win. So your stop loss defines your size, not the other way around. And our rule number 2 is stop loss is based on the market. Position size is based on your risk. You don't control the market, you control your size. But not all trading styles are the same, so your risk shouldn't be the same either. Because the way price moves on a 1-minute chart is very different from how it moves on a daily chart. The core idea is the faster you trade, the more uncertainty you face. The slower you trade, the more room price has to move. So your risk needs to adapt to trade frequency, stop loss size, and market noise. And that's why we have 2 types of styles: scalping on lower time frames and swings on higher time frames. Scalping means fast trades, which last minutes, many trades per day, small price movements, and more market noise. Because you're taking many trades, losses can stack quickly. So you need to risk less per trade, be very consistent, and avoid overexposure. Even if each loss is small, 5 to 10 trades per day can add up, so controlling risk is critical. Swing trading means fewer trades, longer duration, large price moves, and cleaner structure. Because trades are less frequent, you can allow slightly more risk, 1 to 2% per trade, stop losses are wider, and patience is required. You are not exposed often, but when you are, it matters more. So, comparing the 2 styles, the goal for scalping is consistency, and the goal for swings is to catch bigger moves. The hidden risk is not just about risk per trade. It's also about how much you're risking at the same time. Because if you have multiple trades open, each one has its own risk, but together they add up. For example, you take 5 scalps, each one with 1% risk. This leads to a total exposure of 5%. Even if each trade looks safe individually, together they create one big risk. And if the market moves against you, all trades can lose at once, turning a small risk into a big loss. Also, many trades are actually correlated. For example, multiple pairs might move in the same direction. We have the same market conditions, and maybe the same setup repeated. So instead of 5 independent trades, it's basically one big position. This is where your safety net comes in. You set a daily max loss. The recommended rule is about 2 to 3% per day. Once you hit it, you stop trading. How it works? Let's say you risk 1% per trade. So your daily loss limit is 3%. That means after 3 losing trades, you're done. Instead of stacking trades blindly, you limit the number of open positions, reduce size when multiple trades are open, and you are aware of the correlation. And this is how we get our rule number 3. Manage your total exposure, not just individual trades. The faster you trade, the smaller your risk. Before you decide how much you risk, you need to understand what kind of trader you are. Not what you want to be, what you consistently do. So your risk model should match your behavior, your frequency, and your decision-making style. Because if it doesn't, you'll break your own rules. Step number 1. Identify your trading behavior. Ask yourself honestly, how often do I trade? How long do I hold trades? You're likely a scalper if you take multiple trades per day, you stay mostly on lower time frames such as 1, 5 minutes or 50 minutes, you close trades quickly, and you react fast to price. You are likely a swing trader if you take fewer trades, you hold positions for hours or days, you look mainly on higher time frames, and you wait longer for setups. Once you identify your style, you adjust your risk accordingly. Frequent traders take many trades, have more exposure, and more chances to make mistakes. So the solution is to lower risk per trade, have a strict daily loss limit, and controlled exposure. As a selective trader, you take fewer trades, you have more patience, and you take higher quality setups. So the solution is to have a slightly higher risk, wider stops, and less overtrading. The final step is to align with your psychology. This is the part most traders ignore. Ask yourself, can I handle multiple losses in a row? Do I get emotional after a loss? Because if you get emotional easily, you should reduce risk, trade less, and look mainly for quality setups. But if you can stay objective, you can handle slightly more exposure, you can take more trades per day, but still within rules. Now, let's talk about risk to reward consistency. This is where profitability is built, not from being right all the time, but from knowing how much you make when you're right versus how much you lose when you're wrong. The core idea is that every trade has two sides. The risk, what you lose if wrong, and the reward, what you gain if right. Profitability comes from the relationship between the two. The reality is you don't need to win every trade. You need consistent risk to reward. And as an example, let's say you risk 1% and your reward is 2%. If you take 10 trades, you have 5 wins with 2% each. That equals 10%. And you also have 5 losses with 1% each, which means minus 5%. The net result is plus 5%. Even if you're right only 50% of the time, you are still profitable. You don't need a high win rate if your winners are bigger than your losers. This is where people fail. They take profits early and let losses hit full stop. If you find yourself in a position where you take profits early, maybe you should reevaluate your trading style and look more for scalps with smaller risk. As a bad risk to reward example, let's say you risk 1%, but you take profits early, so your reward is only 0.5%. Even with 60% win rate, your wins will be at 3%, while your losses will be at minus 4%. So your net result will be minus 1%. This is why you need to define your trading style before anything else. This is a psychological trap. Out of fear, you close winners too early, and out of hope, you hold losing trades. Emotions flip your edge. The professional approach is to define your risk before entering, stick to it, and don't adjust mid-trade emotionally. Your system should answer before every trade. If I'm wrong, I lose X. If I'm right, I make Y. If that's not clear, it's not a valid trade. So rule number 4 is consistency in risk-reward beats accuracy. You don't need to be right more, you need to be paid more when you are right. Now, let's talk about mindset. This is the part no one talks about, because it's not about entries, not about indicators, it's about how long you can stay in the game. Most traders approach trading like this. How much can I make today? How fast can I grow my account? How do I recover this loss quickly? And this leads to overtrading, increasing risk, and forcing setups, and everything becomes emotional. Real traders, on the other hand, think differently. They look for consistency over time, controlled growth, and protecting capital. Their mindset is, if I keep executing properly, results will come. Why this mindset changes everything? Because trading is a long game. You don't improve from one trade, you improve from hundreds of trades. If you stay long in the game, you see more market conditions, you recognize patterns faster, you refine your strategy, and you improve your discipline. And this way, your edge develops over time. If you don't apply this mindset, you end up blowing your account, resetting your progress, you lose confidence, and you start over emotionally and financially again. And all learning is interrupted. Small, consistent performance over time builds confidence, builds skill, and builds capital. This is how professionals grow. The reality is, trading is not a get-rich-quick game, even though that's how it's often presented online. You'll see people showing fast profits, big wins, and unrealistic expectations. But the truth is, real trading is built over time. It takes consistency, discipline, repetition, and experience in different market conditions. There are no shortcuts. The traders who succeed are not the ones chasing fast money. They are the ones who stay consistent long enough to improve. The shift you need is to stop thinking how much can I make today and start thinking, did I execute my system correctly today? So your goal each day should be to follow your rules, respect risk, and stay disciplined, not to force profits. The truth is, most traders don't fail because of bad strategies. They fail because they don't survive long enough to improve. So our rule number 5 is your goal is not to win today. It is to still be trading tomorrow, next month, and next year. Now let's go quickly over some common mistakes. First one, risking too much per trade. This is the fastest way to blow an account. You risk 5 to 10%, sometimes even more, thinking I'll just win this one trade. But trading doesn't work like that. Even good setups lose. And a few losses at high risk can wipe out weeks or months of progress. High risk doesn't grow accounts, it destroys them. Mistake number 2, not using position sizing. You choose a random lot size and ignore stop loss distance, so the risk becomes inconsistent. On one trade you risk 1%, on the next one you risk 3%, and then on the next one you risk 0.5. No structure equals no consistency. Mistake number 3, revenge trading. After a loss, you might try to recover quickly, increase position size, and force trades. This leads to emotional decisions, bad setups, and bigger losses. It's not about the market anymore, it's about your emotions. Mistake number 4, ignoring total exposure. You're thinking, I'm only risking 1% per trade, but then you open multiple positions and you trade correlated setups. So your total risk becomes 4 to 5% without even realizing. Mistake number 5, you have no daily limit loss. Without a limit, a bad day turns into a worse day. Losses keep stacking, discipline disappears. What usually happens is you lose 2 trades, you try to recover, and then you lose more, and you keep going. And this is how a small loss becomes a big loss. Mistake number 6, inconsistent risk to reward. You close winners early, you let losers hit full stop, and change targets mid-trade. This breaks the math of profitability. And the last one, you only look for profits. You think, how much can I make, instead of how much am I risking? This mindset leads to over-leveraging, forcing trades, and having unrealistic expectations. So most mistakes come from lack of discipline, not lack of knowledge. At the end of the day, risk management is not the boring part of trading, it is trading. Because you can have the best strategy in the world, but without risk control, you won't survive long enough to use it. In the next video, we are going to take this even further and talk about trading and risk management on prop firms, and how risk management changes when you're trading with rules, limits, and funded accounts. I'll see you in the next one. Until then, take care. Bye bye.